Hello, everyone. So NZ IFRS 18 presentation and disclosure in financial statements is a significant new standard in the for-profit suite, affecting the presentation and disclosure of information in the financial statements, in particular information about financial performance. The standard aims to improve the reporting of financial performance by providing investors with more transparent and comparable information and giving them a better basis for analyzing and comparing companies. The standard is equivalent to the IASB's IFRS 18. The new standard becomes mandatory on 1st of January 2027. However, depending on the size and complexity of the entity, preparers will likely need to update their systems, record keeping, and financial statement preparation process in order to implement the standard. Therefore, we encourage all of you to start thinking about the potential impact on your financial reporting now. Before continuing with the overview, I want to highlight the recent visit from the IASB's Vice Chair, Linda Messenhatter, along with Technical Principal Anne McGeechan, as participants in a panel discussion on IFRS 18. The panel, which also included a preparer and an auditor, provided the attendees with insights into the practical implications of applying the requirements in the new standard, as well as how early entities should start preparing for application. I've included these insights throughout the overview where applicable. So how does NZ IFRS 18 fit within the for-profit suite of standards? NZ IFRS 18 affects all for-profit reporting entities and replaces NZ IS 1 presentation of financial statements when applied, either from the mandatory date or earlier under certain circumstances permitted by the standard. Some of the existing requirements in NZ IS 1 have been carried over into NZ IFRS 18 unchanged, or with minimal wording requirements. Changes, I mean. While other requirements have been moved into other standards, such as NZ IS 8 or NZ IFRS 7, or replaced with new requirements. The new standard focuses only on presentation and disclosure, and therefore it will not affect how entities measure their financial performance and the overall profit figure. These new requirements, which I've just mentioned, fall within three main sets within NZ IFRS 18, as shown here. The rest of this overview provides more detail in each of these new sets of requirements. So the first set of requirements relates to categories within the statement of profit or loss and two new required subtotals. The purpose of the new requirements around categories and subtotals is to create a consistent structure for the statement of profit or loss, thus improving comparability for investors across all entities. There are now 5 categories within the statement of profit or loss: operating, investing, financing, income tax, and discontinued operations. I will focus on the first 3 categories in this overview. Starting with the operating category, this will include all items of income and expense arising from an entity's operations, regardless of whether they are recurring or non-recurring, volatile or unusual in some way. The result is intended to be a complete picture of an entity's operations. The operating category can also be seen as a default category, as it will include all income and expenses not classified in one of the other categories. The first of the 2 new required subtotals, operating profit or loss, includes all amounts classified in the operating category and provides a useful and consistent starting point for investors when forecasting future cash flows. The investing category includes income and expenses from assets that generate a return independently and separately from an entity's other resources. Examples include rental income from an investment property or dividends from shares held in other companies. Classifying income and expenses in the investing category will allow investors to analyze returns from standalone investments separately from an entity's operations. The share of profit or loss from equity accounted investments, such as associates and joint ventures, is also included in this category, regardless of whether these investments are seen by the entity as being integral to their operations. Income and expenses from cash and cash equivalents are also specifically included in this category. The second new required subtotal, profit or loss before financing and income tax, comprises operating profit or loss and all income and expenses classified in the investing category. Moving on to the financing category, This category will include all income and expenses on liabilities relating to the raising of finance. So for example, interest expense on bank loans. The financing category also includes interest expense on other liabilities, such as lease liabilities. So ultimately, the financing component on all liabilities will be classified in the financing category. At this point, I want to touch briefly on the concept of a specified main business activity. NZ IFRS 18 requires entities to assess whether they invest in assets and/or provide financing to customers as a main business activity. An entity with one or both of these specified main business activities would classify some income and expenses differently from those entities that do not engage in one or both of these activities. Entities such as banks and insurers would likely have one or both of the specified business activities. Before moving on to an example on the next slide, I also want to highlight that NZ IFRS 18 provides cost relief in certain situations where classification of income and expenses may be tricky. For example, NZ IFRS 18 requires foreign exchange differences to be classified in the same category as the income and expenses from the items that gave rise to the differences. Therefore, foreign exchange differences on a receivable would be classified in the operating category, whereas foreign exchange differences on a debt instrument would likely be classified in the financing category. However, if applying this requirement to a particular transaction would involve undue cost and effort, an entity may classify those foreign exchange differences in the operating category. Now, this slide sets out an example of what the statement of profit or loss would look like under the new standard. The category labels are for illustrative purposes only. The standard does not require entities to label each category. The line items in this example are also only for illustrative purposes, as each entity will be guided by the requirements in the new standard as to which line items will be presented in the financial statements. I'll discuss the guidance on the aggregation and disaggregation of information towards the end of the session. And finally, this example is for an entity that does not have one of the two specified main business activities I referred to earlier. The IASB has developed illustrative examples to show how the statements of profit or loss would look for entities with different activities. This brings me to the end of a very high-level overview of the new categories and subtotals. At the panel discussion during Linda's visit, we heard about some of the potential practical implications of applying these new requirements. So firstly, applying these requirements could be challenging depending on the complexities of any particular entity's operations. So for example, a consolidated group with many reporting levels may find that some of the information required to determine the appropriate classification of income and expenses is sitting at a low or subsidiary level. It would likely then not be possible to perform a classification analysis solely at the group level. Next, an entity's systems need to be able to provide the information required to perform the appropriate classification and presentation. Therefore, this may mean some systems changes would be required to classify certain income and expenses, such as foreign exchange differences. Next, an entity will need to think about staff resourcing for the transition. The extent of judgment required by the new standard, as well as the depth of knowledge required of the income and expenses in the trial balance, means that in many cases, experienced finance staff may need to be involved in the implementation. Such resourcing would require buy-in and support, ideally, from senior leadership. Before moving on to the next set of new requirements, I would also like to highlight the fact that the new categories in the statement of profit or loss are very similar to those in the statement of cash flows, but the nature of the items included in each of those categories would not necessarily be the same. At the panel discussion, Anne McGeechan at the IASB acknowledged the potential for some confusion, but did note that the objectives of the two statements are different. For example, the objective of classifying cash flows in the investing activities category is to identify investments made in long-term assets that will generate future returns. And this would include investments in operating assets. The IASB did consider using different category labels than the statement of profit or loss, but decided that the operating, investing, and financing category labels were the best option. Just a note here, the IASB is currently engaged in a research project on the statement of cash flows. So there may be more alignment between the categories coming up as one of the outcomes of this project, potentially. I will now move on to the next set of new requirements, which relates to management-defined performance measures, or MPMs for short. So MPMs are non-GAAP measures, also known as alternative performance measures. Such measures are not defined by NZ IFRS, and many entities provide this type of information as part of their communications with investors, who will use it to gain insight into how management views financial performance and how the entity is managed. However, investors had concerns about the nature and the extent of the information received and the lack of explanation, which may accompany a change in a non-GAAP measure. Therefore, the new standard introduces a concept of an MPM, and this slide steps us through the definition. It is important to know whether a non-GAAP measure is an MPM, because there are specific disclosures that must be made in the financial statements about these measures. So firstly, the measure must be a subtotal of income and expense. Adjusted operating profit or adjusted EBITDA are examples of subtotals of income and expense. Measures such as free cash flow, as well as measures relating to assets and liabilities, are not MPMs because they are not subtotals of income and expense. NZ IFRS specified subtotals, for example, the new mandatory subtotal, operating profit or loss, are not MPMs either. NZ IFRS 18 also specifically states that gross profit and similar measures, such as net interest income for financing institutions, are not MPMs, as these measures are commonly used and well understood, and therefore specific disclosures are not required. Next, the measure must be used in public communications outside the financial statements to qualify as an MPM, such as used in press releases and investor presentations. However, do note that oral communications and social media posts are explicitly excluded for the purposes of identifying MPMs. Finally, a measure must communicate management's view of an aspect of financial performance of the entity as a whole. NZ IFRS 18 presumes that a measure that is used in public communications outside of the financial statements communicates management's view. However, an entity can rebut this presumption if it has reasonable and supportable information for the assertion. NZ IFRS 18 does contain guidance, which may constitute reasonable and supportable information. Now, this slide sets out the specific disclosures required for those MPMs identified using the criteria on the previous slide. All disclosures relating to MPMs must be made in a single note in the financial statements. So in summary, NZ IFRS 18 requires explanations of why the MPM is reported, how the MPM is calculated, and any changes to the MPM. A reconciliation back to an NZ IFRS defined subtotal is also required. This reconciliation must include the income tax effect and the effect on non-controlling interests for each reconciling item. Determining the income tax effect of each reconciling item could be complex, and so the standard does allow for a simplified approach. All of these disclosures are intended to provide transparency on these measures to investors. The requirement to disclose this information in the financial statements does, however, mean that the information will be subject to audit. Now, this brings me to the end of the high-level overview of the new requirements around MPMs. So at the panel discussion during Linda's visit, we heard that some entities currently do disclose non-GAAP measures with reconciliations to the nearest GAAP number. For these entities, it may be easy enough to identify which non-GAAP measures are MPMs as defined and relocate the associated information into the financial statements. Unless already disclosed, additional information required on non-controlling interests and tax for individual reconciling items will be a change. Non-GAAP measures may reduce, potentially, as a result of the new requirements. For example, an entity may decide to stop reporting an EBIT number in favor of reporting the new subtotal profit before financing and income tax. And finally, auditors will have looked at non-GAAP measures, but they have not previously been subject to audit. Auditors would now need to think about these at the preparation of financial statements phase instead. So entities will likely need to prepare these disclosures earlier than they may have done so before. Moving on to the third and last set of requirements. This set of requirements relates to the grouping or aggregation and disaggregation of information. The IASB developed these requirements in response to investor concerns that the way entities group information in financial statements does not always provide the information they need for their analyses. For example, some information is not shown in enough detail, while some other information would be obscured by too much detail. Before getting into the requirements, it is useful to keep in mind what the objective of financial statements is. It is to provide useful information to investors or users. To achieve this objective, an entity will present information in the primary financial statements and disclose information in the notes. Bear in mind, only material information needs to be presented and disclosed. The primary financial statements and the notes each have a role to play in providing useful information to users. These roles are specified in NZ IFRS 18, and an entity must use these roles to determine where to include material information in the financial statements. So you may be wondering, what exactly are primary financial statements? So these include the statement of profit or loss, the statement presenting comprehensive income, and the statements of changes in equity, financial position, and cash flows. The role of these primary financial statements is to provide useful structured summaries of income, expenses, assets, liabilities, equity, and cash flows for investors. This is a key principle in the new standard. Entities are required to present line items and subtotals, in addition to those specified in NZ IFRS, if necessary to provide a useful structured summary in the primary financial statements. Such subtotals may be MPMs if the criteria are met. Likewise, an entity is not required to present a line item specified in another standard or in NZ IFRS 18, if doing so is not necessary for the statement to provide a useful structured summary. NZ IFRS 18 does make it clear that certain totals and subtotals are mandatory. So for example, all entities are required to present the operating profit or loss subtotal in their statement of profit or loss. Requiring the presentation of certain totals and subtotals helps to maintain the basic structure of the primary financial statements, which will aid comparability across entities. The role of the notes is twofold. They provide material information to enable users to understand the line items in the primary financial statements, and they also provide material information to supplement the primary financial statements with additional information to achieve the objective of financial statements. The roles of the primary financial statements and the notes feed into the general principles of aggregation and disaggregation of information. So in summary, entities must place items in the primary financial statements and the notes to fulfill their complementary roles. They must aggregate items that share characteristics and disaggregate items that have different characteristics. And they do need to group items in a way that does not obscure material information or reduce understandability. NZ IFRS 18 explicitly states that an entity can label an aggregation of items presented or disclosed as other, only if it cannot find a more informative label. The standard provides some guidance on how such a label can be found. If a more informative label cannot be found, then the label must be as precise as possible. So for example, using a label, other operating expenses. The new standard does contain quite a bit of guidance around how to apply these new principles of aggregation and disaggregation. Now, this slide specifically covers the presentation of expenses in the operating category. Tying back to the role of the primary financial statements, expenses must be presented in the operating category in a way that provides the most useful structured summary of these. To do so, an entity must classify its expenses based on their nature or their function. But the new standard does permit a mix of nature and function classifications, if, again, this will provide the most useful structured summary. If an entity classifies its expenses based on function, additional information on the nature of certain specified expenses must be disclosed in a single note. These nature expenses, or these types of expenses, are depreciation, amortization, impairment losses and reversals, and write-downs of inventories and reversals. This brings me to the high-level overview of the new requirements around grouping of information. At the panel discussion during Linda's visit, we heard that these new requirements provide entities with an opportunity to refresh their financial statements. Entities will likely learn more about their businesses by having to apply these new requirements. So for example, having to dig into each of the line items to discover what's there. This allows for an opportunity to reconsider how best to provide the information that investors may have been asking for. For example, perhaps it would be appropriate to present certain requested information in a separate line item in the statement of profit or loss, if doing so helps to provide investors with, again, a useful structured summary. Applying the requirements could be quite challenging and involve judgment. For example, how do you get the balance of information just right? Not too much and not too little. Entities need to understand what's important to their investors and other stakeholders as a starting point. And there'll likely be a benefit to engaging with auditors on the level of documentation they expect to see around the judgments made. It may also be useful to get early agreement on the approach to aggregating and disaggregating information with auditors early on to avoid any potential disagreements later on. So now that brings us to the end of the high-level overview of the key new requirements in NZ IFRS 18. This slide notes some other key changes as a consequence of the new standard. There are some limited changes to NZ IFRS 7, Statement of Cash Flows. Amendments to NZ IFRS 7 specify that operating profit or loss must be used as the starting point for reporting cash flows from operating activities using the indirect method. Also, most entities will be required to classify dividends and interest paid and cash flows from financing activities, and to classify dividends and interest received in cash flows from investing activities. Removing the choice of where to present these items is expected to simplify practice and reduce diversity in presentation. Amendments to NZ IFRS 33 earnings per share and NZ IFRS 34 interim financial reporting have also been made, relating mostly to the new concept of MPMs. We have, just so you know, we have created updated versions of the standards mentioned on this slide to incorporate the amendments made as a consequence of NZ IFRS 18. You may find these helpful. They can be found on our NZ IFRS 18 webpage as guidance material, but they are not yet available on the Standards Navigator. Now, this slide highlights some of the key existing NZ IFRS 1 requirements that have not changed and have therefore been moved into NZ IFRS 18 or NZ IAS 8, basis of preparation of financial statements, substantively unchanged. Now, some of you may notice that this title of NZ IAS 8 has changed. This is to reflect that NZ IAS 8 now contains the going concern requirements, as well as the fair presentation and compliance with IFRS accounting standards requirements that were previously in NZ IAS 1. All requirements relating to the selection and application of accounting policies, as well as disclosure of sources of estimation uncertainty, will now be found in NZ IAS 8 as well. So as I noted at the beginning of the overview, the mandatory date for NZ IFRS 18 is 1st of January 2027, but can be applied earlier as permitted by the standard. When applying NZ IFRS 18 for the first time, an entity must reconcile restated comparative amounts to previously presented NZ IAS 1 amounts. This reconciliation must be done for each line item in the statement of profit or loss. The beginning of the comparative period is 1st of January 2026 for those entities with 31st of December reporting dates. Therefore, as mentioned at the start of this overview, it is important to start thinking about the potential impact on your financial reporting now, so that you'll have enough time to implement the standard. This brings us to the end of the high-level overview of NZ IFRS 18.